On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Morning, all. Hope everyone is well. I wanted to talk today about the balancing act that policymakers are facing. We've seen some really good developments across financial markets in recent times. We've seen inflation slow, we've seen the labour market ease, which is important, and we've seen economic growth just start to soften a little bit. And that's been heartening for investors because these are necessary developments for inflation to keep coming down and for interest rates to stop rising. But it's not as simple as that because the outlook is still very finely balanced. We want conditions to weaken, but not too much. Now, last week we had our own labour force report in New Zealand, and we saw the headline unemployment rate increase to 3.9%. That's still very low by historic standards, but it's the highest we've seen in more than 2 years, and it's above the multi-decade low that we saw. I think the beginning of last year when unemployment fell to 3.2%. That was the lowest we'd seen since the 1980s. So we've seen it rise since then. We also saw a very telling rise in the underutilization rate, and that is a broader measure of untapped capacity in the labour market. And it includes things like, maybe part-time workers that actually want more hours or other measures that give a better, broader indication of labour market slack. Now, the underutilisation rate rose to 10.4%. That's the highest we've seen since June 2021, so a little more than 2 years ago. And something else that was really important in that labour force release from last week was that wage growth continued to fall. And this is really important for the Reserve Bank. We saw the private sector labour cost index increase by less than people were expecting. So it went up, but by less than expected. And we saw annual wage growth using this measure. And there's several you can use, but using the labour cost index for the private sector. So we're ignoring public sector wages because we've seen some one-off changes there, some big increases that sort of skew the numbers. Private sector labour cost index, that fell to 4.1% in terms of the annual wage growth we've seen. Now, that's the lowest in a year, so moving in the right direction. It was a similar story in the United States. We had the monthly payrolls report out last Friday night in the US, so we got it on Saturday. That was weaker than expected. The number of jobs created during the month was the second lowest on a monthly basis since the end of 2020. So definitely a little softer than expected. And the headline unemployment rate in the United States also increased. It increased to 3.9%. That's just coincidentally the same as ours, but it has been pushing higher. That's the highest we've seen since early last year. And it's above the multi-decade low that we saw earlier this year. Earlier this year, the US unemployment rate fell to 3.4%. That's the highest since 1969. So same story in both countries. And just like New Zealand, we saw wage growth soften in America. Average hourly earnings rose less than expected and slowed to the lowest in more than 2 years when we look at the annual change. So this is all really important for the inflation picture and for what central banks do with interest rates, because tight labour markets have been a really key piece of the inflation puzzle in recent years. As businesses have needed to push up wages to attract workers, if there's no more people left, you've got to offer good wages to pinch someone from somewhere else. So that puts upward pressure on wages. And you've also got to pay your existing staff more because other competitors are trying to pinch them because they're also struggling to fill gaps. So all of that sounds good in theory, and it is good. Lots of parts of society that have been underpaid or haven't had the wage increases that they've deserved, and teachers, nurses, lots of professions have had attractive wage rises. So it is good, but it also leads to broader price pressures, because what happens when you're a business is, if you're having to pay your staff more because the labour market's really tight, unemployment's really low, what you're inclined to do is just put your prices up to recoup those higher wages. And you can usually get away with it in an environment where unemployment is really low, because as everyone's employed, everyone's got jobs, and everyone's getting good pay rises themselves, they will actually accept those higher costs that they're seeing out there, because they're in a good position too. So then that wage growth and that tight labour market starts fueling broader price pressures and broader inflation, which then pushes the cost of living up. So those same staff go and see the boss. Boss, cost of living still going up. I need another pay rise, and those employers, for the most part, have to pay those people more, because you've still got this dynamic where you've got a really tight market. And before you know it, you can end up in a wage price spiral. And once you're in that situation, it's really hard to get on top of it. So, because of this, unfortunately, the truth is, to really get inflation under control, we need to see the labour market ease. We need to see a little bit more unemployment, and we need to see those wage pressures subside. Things are just too overheated in lots of parts of the world. And that's really tricky, because while we are seeing that, we don't want to see too much softness across the labour market. We don't want to see unemployment rise too much, because it's one thing to have things ease up just enough to take the edge off the inflation picture. But if things soften too much, if you get too much of an economic slowdown, if you see unemployment spike very sharply, then you can end up in recession. And that's not so good either. So I guess at the moment we sit here and we think we've made some progress. We've seen wage pressures soften. We've seen unemployment rise just a little bit. That's taken the edge off inflation. We're hopeful that the Reserve Bank of New Zealand, the Federal Reserve in the US, and others around the world are in a position where they don't need to raise interest rates anymore, and all of that is good for investors, for financial markets, for borrowing costs. But it's still a really difficult needle to thread, because what happens is, when unemployment starts trending up, it often tends to keep trending up. It's very hard to just have it rise a little bit and then say, look, okay, that's enough unemployment rate. We want you to just stay put there and not go up any further. Because once those wheels are in motion, labour markets can start to sort of keep weakening. So that's really important, because even a modest increase in the unemployment rate can often lead to an economic downturn, or at least it makes one hard to avoid. And if you look at the United States, since World War II, which is 75 odd years ago, over that 75-year period, we've actually never seen a time where the US unemployment rate has risen even 0.5% without a recession occurring. And the numbers that I'm using there, like when I look at this, I'll use the 6-month moving average of the unemployment rate, and I will compare that to um, the lowest that indicator has got to over the last 12 months. And at the moment, it's sitting at about 1/3%, about 0.33. So we're not really at that 0.5% sort of trigger. They call this the Psalm rule, after Claudia Psalm, who was an economist, I think, at the Federal Reserve a few years back. And she didn't come up with this rule or this indicator to try and predict recessions. She came up with this as a way for policymakers to more accurately pinpoint the time when a recession was starting, so that they could get stimulus checks out to the people that need them right away to try and soften the blow. So it's never meant to be an indicator or a predictor, but it still is something that is quite useful to look at and follow. And I think I think that's something we need to be very conscious of. The fact that anytime we've seen the unemployment rate in the US rise, even 0.5% based on that sort of that way of measuring it, there's been a recession. So that doesn't mean one is guaranteed this time. If we do see unemployment push up a little bit higher, if you go back further than the last 75 years, you'll find instances where a rise of that degree and unemployment didn't come hand in hand with a recession. But I guess the point I'm trying to make is that it doesn't take much for economic conditions to weaken when you do see unemployment spike in that way. So definitely something to watch. We should be very encouraged by the fact that we've seen labour markets ease, unemployment push up a little bit. That does tell us that wage pressures will subside from here, and that should give some comfort to the Reserve Bank of New Zealand, the Federal Reserve, that the work they're doing is succeeding, and that hopefully means interest rates won't go up any further from here, and at some point they'll come down. So from an economic perspective, from an investment perspective, these are important developments, positive developments, but we just don't want to see economic conditions or the labour market weaken too much. I think what is probably in our favour here in New Zealand is that we've had very strong migration, and that's added to our pool of workers. And that's part of the reason we've seen the labour market ease. That's part of the reason we've seen the unemployment rate rise from 3.2 to 3.9. It hasn't been because you've seen mass layoffs everywhere. No one wants to see that. No one wants to see job losses. But a big part of that increase in the unemployment rate is we've had more workers come into the country, which has increased the pool of labour, the labour supply, and that is actually working in our favour. So the strong migration that we've seen, and it looks to be continuing over the short term at least, that actually could be something that saves us from a technical recession with a bit of luck, because it is actually easing some of those labour market pressures we've got, giving businesses a greater pool of workers, and we're seeing wage growth come down for that reason, rather than sort of having to orchestrate widespread job losses. So we're very lucky in that regard. So I guess to wrap up, we should be heartened by the progress that central banks are making. There's a very good chance that interest rates, at least in New Zealand and the US, have peaked and will now go sideways and at some point decline. But I think it's also important to remember that we're not out of the woods yet. We're actually in quite a risky time for the global economy, because it's sort of at this point where you can take one or two paths. You can end up in that soft landing scenario where things just slowly soften, and we manage to thread the needle accurately and appropriately, or you could actually see central banks overdo it, keep monetary conditions tight for too long, cause too much of a slowdown, too much of a spike in unemployment, and then you might sort of see a recession, or at least an economic downturn of some magnitude. So still very much a watch this space. So far so good, but I think the next big decision for some of these policymakers will be, when should they start loosening policy settings to make sure they don't overdo it. So hopefully that is useful. We will talk again soon, and these are all issues that we will be monitoring very closely. Thanks for listening.